Investors are gearing up for interest rate decisions by major global central banks this week, beginning with the U.S. Federal Reserve and a widely expected quarter-point rate cut after its two-day meeting tomorrow. Right now, we want to bring in Mark Cabana. He is head of U.S. rate strategy at Bank of America Securities. And Mark, the question we've been asking people a lot is why? Why do the cut now? If you're not sure and you're clearly signaling and basically telling people that you're going to slow down after this, you may even stop cutting rates. Why go ahead with it? Why not wait till January and see how things settle out?
Yeah, it's a great question. Well, first of all, thanks so much for coming in. It's a thrill to have you here at Bank of America.
Thanks for having me.
Yeah. So we do expect a bit of a hawkish cut this week. So the Fed is widely expected to cut by 25 basis points, but signal that they're moving to a more gradual pace of rate reductions on a go-forward basis. Now, your question, why? The Fed has long believed that they're in a restrictive stance and they want to normalize monetary policy. They worry about keeping monetary policy too tight for too long. And while they've seen progress on inflation slow to some extent, they have also seen that the labor market continues to moderate. And they want to try and do their best to balance things. They likely worry that if they don't cut, they risk upsetting markets. So they're going to go ahead with this cut and then signal that they're likely moving to a bit of a more gradual pace.
Upsetting markets may be the key thing that you said, because if you look at the labor market, we're in great shape. If you look at the unemployment rate, most of the data that we've seen recently suggests that not only is the economy chugging along and in fact, in some cases, picking up, inflation is much stickier than people had expected. What happens if we go into 4 or 5 years of inflation that is above target?
If we go into that period, I would certainly expect that you're going to see interest rates remain high, and there's going to be a risk that inflation expectations start to unanchor to some extent. Now, the Fed is going to monitor inflation expectations very, very closely. That is arguably the single most important of all of the things that they care about. And if they do see that inflation expectations run the risk of unanchoring, then they'll start to hike again. And that is a risk right now that is very much not on the market's mind. No one thinks that the Fed is going to be hiking again. We're still expecting and pricing rate cuts in 2025. But it is a risk that if we see inflation stay high and maybe start to reaccelerate, that the Fed could be pushed into doing that.
So what would you do if you were making this decision today?
So I think I would do what is widely expected to do. I think I would go ahead, I would cut, because I've signaled that that is my intention. Markets are expecting it.
Okay, we just go back to this? Everybody who says we would cut starts with that very same thing. We've signaled this to the markets, so we have to go ahead with it. If you were just looking at the data, would you still cut?
I think I would, largely because while inflation has been a little bit stickier, there are signs that the labor market continues to moderate. You're right, it's very healthy by all accounts. The Fed wants to keep it that way, but we have seen that recent headline establishment employment data has been cooling to some extent. You've seen continuing jobless claims tick up a little bit. So there are signs, I think, that the labor market is continuing to cool, and the Fed doesn't want to stay too long and then result in any type of unnecessary tightening.
Let's talk about the amount of debt that we have out there. It's $28 trillion total marketable debt, but you've also got, at this point, $36 trillion in total public debt. It starts to add up after a while.
It does. And as we were mentioning earlier, it adds up really fast as well if you've got rising interest rates or elevated interest rates, because interest cost just comprises a larger share of the total amount of debt outstanding, and that causes the debt outstanding to continue to grow.
You think that's in the Fed's mind as they're thinking about cutting, or no?
I think that they are most focused on labor and inflation, but certainly they are aware of the total amount of debt that is outstanding. But I don't think that they're going to be cutting rates to, let's say, try and help out the Treasury Department to a large extent. I think that they're going to stay focused on their dual mandate.
What's the perception, very quickly, from the debt markets? Is there a point where you think bond vigilantes or somebody else rise up and say too much?
Yeah, we get a lot of questions about bond vigilantes. I would say that the rates market is very well aware of the debt situation. They're very well aware of rising interest costs and what that means. And we do think that the market is going to essentially price in a greater amount of Treasury cheapening as a result of that. Now, when I say Treasury cheapening, we specifically think about this through asset swaps. It's kind of the spread to the expected path of the overnight rate, something that's a little bit more technical in the bond market. But you're already seeing the market that's pricing in 30-year Treasuries that are 80 basis points cheap to the expected path of the overnight rate. That's going to continue to grow, and that is going to continue to put upward pressure on rates over time, slowly. But we think that, look, in terms of what matters for rates, it's really the expected path of the Fed. It's about growth. It's about inflation. It's about the labor market. And as long as those things continue to cool, then rates will remain in check. But if there are signs that inflation is accelerating, then that's when you can really see a larger move at the back end of the curve.